Well, good morning, everyone. This is Susan Milazzo with the California Mortgage Bankers Association, and welcome to our June 2019 webinar for our Mortgage Quality and Compliance Committee. Very happy that you could join us. We do these on a monthly basis. It's always the fourth Thursday of the month and on a different compliance topic in the industry. So if you have received the notice for today's webinar through a friend or a colleague and would like to receive future notices personally, go ahead and shoot me an email, susan@cmba.com, and I'll make sure that you get added to our distribution list going forward. I'd like to give thanks to this year's Mortgage Quality and Compliance sponsor, and that's the Compliance Group. Typically, we have a representative from the company that joins us and talks a little bit about the company. They weren't able to participate today, so I'm going to share some information with you. The Compliance Group is a premier nationwide provider of innovative compliance and quality control solutions to the financial services industry. In a business with constant regulatory evolution, the Compliance Group is uniquely qualified to provide our clients with the confidence and surety that their business is well protected. Our mission is to create engaged financial service client partners by supporting their efforts in effectively managing their compliance and quality risks. Their team of highly qualified, meticulously thorough, and passionate individuals are focused on creating exceptional experiences with every interaction they have with their clients and partners. So I want to thank the Compliance Group for their support this year. Before we get into today's agenda, I'd like to bring to your attention a few upcoming events for the California MBA. We have our next regional networking event that'll be happening in Northern California. That'll be on July 11th in Folsom, and will be hosted by Sierra Pacific Mortgage. Great opportunity to meet some of your colleagues in the mortgage industry if you happen to be in this area. In July, we have a Campac golf tournament that will be held at the Presidio on Sunday, July 14th. Of course, that will be right before our big Western Secondary Market Conference that'll be happening July 15th through the 17th in San Francisco. Following that, in August, we have another golf tournament for supporting our Political Action Committee. That'll be at the Rancho Bernardo Inn on Sunday, August 11th, and that'll be right at the kickoff of our all-new Mortgage Innovators Conference, which will focus on technology solutions for every aspect of the life cycle of the loan. So great conference and golfing and networking opportunities to share with all of you. All of that information, by the way, is available on our website, cmba.com, under the Events tab. So with that, I will turn it over to this year's Mortgage Quality and Compliance Committee Chair, and that is Monica McCarthy with Crosscheck Compliance. Monica?
Great. Thank you so much, Susan, and welcome, everyone. Honored to serve as committee chair along with my co-chair, Carol Carson from Plaza Home Mortgage, and welcome everyone to today's program. We're going to kick off today first with a legislative update from the MBA's legislative advocate, Pat Zenzala.
Thank you. What I'm going to do today is to cover a couple of bills I think you'd find of interest. And before that, actually just let you know where we're at in the legislative process. We're in the middle of kind of heavy policy committee hearings for bills in the second house. So we're over halfway through the legislative session now, and all the bills that made it through the first house are now being heard in policy committee for the second house. So very, very busy time for the legislature. The two bills that I wanted to cover are first AB 25. This is one of probably a half a dozen or so bills that attempt to clarify the California Consumer Privacy Act to make it more understandable, address some of the issues in the act that passed last year. And I think of the bills that are out there, this has one of the greatest likelihoods of continuing to move through the process. It's an uphill battle because the chair of the Senate Judiciary Committee had one of her bills on this topic die earlier this year due to the opposition. She wanted to expand the private right of action in the Act, which is of great concern to business groups that would have to comply with this Act as far as frivolous litigation. And her bill died, and she's made it pretty clear that, without an extended private right of action, she's not really open or not interested in seeing many of these other bills pass, and they all go through her committee. So this bill is AB 25, and it makes an important fix to the CCPA, the California Consumer Privacy Act. And it does so by clarifying that employees and job applicants acting in their professional capacities, so as essentially employees, are not classified as consumers under the Act, because currently under the CCPA, the definition of consumer includes any California resident. So conceivably, job applicants and employees could be covered, and all of the rights and remedies under the Act would apply to employees, not in the consumer kind of role that the Act was contemplated to impact. So anyhow, this is an important clarification for businesses in California. The second bill that I want to mention.
I'm sorry. Can I ask you a question just really quick? I think
Sure.
our listeners might be interested relative to CCPA, not specifically this bill, but the Act itself. Isn't it true that our Attorney General will be starting the reg process this fall? I think that's the timing that we're looking at. Is that correct?
Correct. Yeah, in fact, it's very likely we're going to see draft regulations by this fall, and then with the objective of having them be finalized by the primary effective date, which would be July of 2020. So it'll be a busy fall following whatever bills pass out of the legislature, which we'll know really by the end of August. And then with the rules coming out, or at least the draft rules, industry will be able to comment on those rules once they're released, once the draft rules are released.
Got it. Okay, thank you. We'll go ahead and move on to rent caps.
So the second bill is of great interest, especially on the commercial side, but generally of interest to both the residential and commercial side of the association. This is the AB 482 is the most recent rent cap proposal in California, and this bill actually has moved further than any other rent cap proposal I've seen in California. So and at the end of the process in the first house, so on the assembly floor, the California Association of Realtors actually removed their opposition based on some compromise amendments that they proposed. So they're now no longer opposing the bill. And basically, as the bill was amended, it would create a situation where it would limit the maximum rent increase in a 12-month period to 7% plus CPI. So that would be 7% plus CPI annually would be the maximum rent increase in California if this bill were to pass. There would be an exemption for owners who have 10 or less single-family homes. So essentially, smaller leasing entities would have the ability to be exempt from the provisions of the Act. And then it would also create an exemption for housing that's been issued a certificate of occupancy within the previous 10 years. So essentially, the rent limitation provisions wouldn't apply for the first 10 years after a structure is built. And those would be the primary provisions of the bill, and then also it would sunset in 3 years. So unless it were reenacted, the provisions would go away after 3 years after the original enactment. So with those amendments, realtors who have typically opposed these types of bills have removed their opposition, but there's still a large amount of opposition, including our association still oppose the bill. And the governor is very supportive of this and legislative leadership, so I think this is very likely to continue to move this year. The one final point, Susan, I wanted to mention is that we've already seen an initiative um, be approved to go out for signature for 2020. So essentially on rent control. So the AIDS Healthcare Foundation has submitted a new initiative, and they've been given approval to seek signatures. So we could see another rent control ballot initiative show up for 2020 if this bill doesn't pass. Likely this is being used to pressure the legislature to move on something in the legislature versus have another fight in the ballot.
Wow. Well, rent control and split tax rule.
Yeah, for 2020, yeah.
Yay!
It's going to be a busy year for business.
Looking forward to it. All right. Well, thank you, Pat.
Sure.
Okay, and so next up, we're going to have a legal update by the CMBA's GC, Michael Pfeiffer. Michael?
Thank you, Monica. Well, good morning, everybody. Susan, if you go to the next slide, I'll get into the meat of this. This is I typically on these presentations, I cover a particular case or a particular enforcement action, and that's what this is. It's one of the, as everybody knows, the CFPB the volume of their enforcement activity has decreased. This is one of the cases, however, that they have been maintaining it, and it concerns compliance with HMDA regulations. And interestingly, it's not on the newer regulations, but it goes back to the years 2013, 2014, 2015, and 2016. And I'm not sure. I mean, I think they felt they had to bring the enforcement action. I'm not sure what message they're sending to us. The CFPB under Kathy Kraniger claims that they're not regulating by enforcement, but I think it's hard to ignore enforcement activities, particularly when you see consent decrees like this one, to pay attention to what's going on. And I'll kind of go briefly through the facts and then try to point out what the moral of the story might be, as it were. The consent order indicates that Freedom had originated more than 50,000 home purchase loans, including refinancings during that period, and for a total of more than $10 billion. And they reported HMDA data on over 1 million covered loan applications. So we're talking about a large volume of HMDA reporting here. And it indicates also that they had 700 loan officers and 6 to 8 call centers. So this is a large and diverse and widely distributed marketing effort on their part. Their proprietary system called Lakewood allowed loan officers to collect and enter application information into an overlay called the sales portal. And what that system did was, if it detected that certain application information was missing, it was programmed to initiate a hard stop that prevented the file from advancing or being saved in sales portal. So the loan officers were basically unable to go forward with the processing the application until that information was provided. And one of the categories, of course, was the type of information that's collected for HMDA. If they didn't provide the requested race or ethnicity, then the sales portal would stop, and it instructed the loan officers to enter information into the portal in a way that would get around this. And so the loan officers basically decided that certain loan officers apparently were told by their managers that when the information was not provided, the loan officers should select non-Hispanic white as the racial category. And the consent order points out that this was not limited to a specific location, loan officer, or time period. So obviously, maybe it was word of mouth or whatever, but this practice was across all their call centers. So it wasn't just 1 or 2 loan officers that were doing this, or 1 or 2 managers. This was something that had kind of been, they made a big point of emphasizing that this was something that had gone on. They said that in approximately 300 incidents, Freedom had incorrectly reported applicants as non-Hispanic white, even though the applicants had provided requested information other than that. which was an additional sort of overlay on it. And it was kind of surprising that that had happened. Next slide. So there was additional violations having to do with the marital status of the applicants. And again, in Sales Portal didn't allow their marital status to be saved and would remove the co-applicant's income if the category was selected as information not provided. So essentially, people would would summarize or put their best guess as to what that information was. And instead of correcting this, Freedom used a workaround of selecting the applicant's sex when the applicant didn't provide one for the telephonic applications. Some people complained, and but the way that the system was set up, the loan officers couldn't go back in and correct it, and they were told that the information could not be changed. Sorry for the spelling error there. So you had all this information that was being incorrectly basically coded into the system, and the CFPB makes a big point of emphasizing that Freedom didn't maintain procedures reasonably adapted to avoid those errors. They don't elaborate on that. I think they drew the conclusion sort of looking backwards with 20/20 hindsight, basically saying, look, if this happened, you could not possibly have maintained procedures reasonably adapted to avoid the HMDA errors. And I think part of that, so that's one of the lessons on this, is that if you do have something like this going on, you need to do your best to make sure it doesn't go on. And apparently Freedom didn't. This was allowed to sort of spread, and maybe some of the managers instructed loan officers. I don't know the details, but Freedom didn't take remedial actions to make adjustments to their system to prevent this from happening. And so, obviously, the CFPB brought enforcement action against them, and they entered into a consent order. Has a lot of the similar provisions that you see in all of these consent orders, basically requiring them to implement and maintain policies to avoid this kind of thing happening in the future, to make sure they're complying with HMDA, and to maintain a program to test for that, make sure they have solid data integrity, and to address errors promptly. Next slide. Also requires them to basically training requirements to make sure that the personnel are properly trained, and then they wanted the Freedom to submit a comprehensive compliance plan that included all of this, and required the board to review all submissions, including the plans, reports, programs, policies, and procedures, and to make sure that the board was responsible. So they're setting it up for the board of directors to basically be personally liable if they don't correct this in the future. And then there's ongoing reporting requirements and to deliver a copy of the consent order to any successors. So those are all kind of standard provisions. If you enter into a consent order with the CFPB, you don't get a free ride. They maintain control over you in the future and make sure you don't do this again. And here they imposed a civil money penalty of $1.75 million, which, actually that's, if you look at things, that's not a lot for. I don't know exactly how many violations there were. We know there were at least 300. But when you consider some of the civil money penalties in the past, this is not. But it's certainly, almost $2 million going out the door is not a happy event. But the main reason for including this was, number one, this was a recent enforcement action, and number two, it shows you how easily these kind of violations can proliferate and basically infiltrate loan origination systems. There's always going to be areas where there's some lack of clarity and that sort of thing, and it's important that that members take into consideration the fact that each one of these rules, particularly HMDA, which is very specific and requires specific collections of data, not to just make decisions to favor loan production, but to make sure that all the I's are dotted and the T's are crossed. And if there is a problem or some lack of clarity with respect to what people are supposed to code into the system when they enter the loan applications, they need to check with their compliance department and have that addressed on a company-wide basis, and not just have these off the record workarounds. So that's my report on that one, Susan. And Monica.
Great. Thank you so much, Michael, and also a good reason to do your fair lending analytics, because the CFPB is continuing with their focus on fair lending, it appears. Great. So next up then, if we could have the next slide, Susan, thank you so much. We're going to move into our main presentation on loan originator compensation. And we have two very savvy speakers for you today. First, I'd like to introduce Rich Andreano. He's a practice leader of the mortgage banking group at the Ballard Spahr law firm. Rich has devoted over 30 years of practice to financial services, mortgage banking, and consumer finance law. Rich advises members of the mortgage and settlement service industries on regulatory compliance and related matters, including issues concerning Dodd-Frank, RESPA, TILA, ECOA, HMDA, FCRA, and state laws. Rich is the author of the MBA Compliance Essentials Loan Originator Compensation Rule Resource Guide, and he's co-author of the MBA Compliance Essentials on TILA RESPA Integrated Disclosure Resource Guide. He has also spoken on this topic on LO Comp at our Legal Issues Conference last December, so we're very pleased to have him back on this very timely topic. Next up, I'd like to introduce Michael Barone. Michael is also an attorney and serves as the Executive Director of Compliance at MQMR. Michael has over 20 years of experience representing nationally recognized mortgage lenders and brokers on all types of federal and state compliance, transactional, and litigation matters. Michael is also a partner of the law firm of Abrams, Garfinkel, Margulis, Bergson, with offices in New York and California. He is the partner in charge of the firm's mortgage compliance department and is a member of the firm's real estate and banking departments. So thank you for joining us as well, Michael. So let me kick it over. I believe, Rich, you're going to be handling the first slides.
Yes, and thank you, Monica, and good day, everyone. What we're going to do here is first go over a few basic aspects of the rule, just in summary form to sort of set up the discussion later on. What we'll also do then is address some asks that the National Mortgage Bankers Association has made to the Consumer Financial Protection Bureau. Then after that, Michael and I will go into a lot of various scenarios that are frequent questions that we receive, and I know the California MBA and the National MBA receive regularly. And so we've tried to cull some of the most popular ones together, and we'll address them for you and give us your thoughts. Now, first of all, let's take a look on the next slide, where the basic prohibition of the rule we know is that there is a term and proxy prohibition. And Suzette, my screen isn't showing. Oh, there you go. That'd be great. Thank you very much. And basic prohibition is no loan originator, or LO as we refer to, may receive, and no person may pay a loan originator, either direct or indirect, compensation that's based on a term of a transaction, the terms of multiple transactions by that same originator, or the terms of multiple transactions by multiple loan originators. That last aspect of the rule is how the Bureau interprets the rule to prohibit payments based on profits, because they deem profits to be the collective originations by multiple originators of either a company or a branch, whatever unit you're looking at. There's also the proxy factor, and that compensation based in whole or in part on a factor that's not a loan term itself, but is a proxy for a term of the transaction, then is in fact varying compensation based on the term of a transaction. Now, important elements then, what the heck is a term of a transaction and what the heck is a proxy for a term? Well, term is pretty much any right or obligation of the parties, the creditor and the consumer, to that transaction, and it includes the rights and obligations in the loan documents. And we have some examples that'll touch on aspects of this, and also the fees and charges. But here they define the fees and charges that constitute a term as those that must be disclosed either in the loan estimate or closing disclosure, or if you have a transaction that's subject to the rule but isn't subject to TRID, the good faith estimate, and HUD-1. So term of a transaction, a broad concept. Proxy, and as we'll get into this later, the original rule adopted by the Fed had the concept of a proxy, but it was ill-defined, and that caused a lot of confusion and difficulty in applying the rule. And so ask was made from the industry to the Bureau that this was an area that needed some clarification. So they adopted a definition of proxy. It's an improvement, but as we'll see, it's still not perfect. And so it's something that's a factor that's not a term of a transaction. They use that word factor to describe something that might be a proxy. And it becomes a proxy for a term if two conditions are satisfied. One, that factor varies consistently with one or more terms of a transaction over a significant number of transactions. In other words, there's a correlation between the factor and one or more loan terms, typically. Second, and this is a very important element, is the loan originator has the ability to direct or indirectly add, drop, or change. Shortly, I say affect whether the factor is present in a transaction or the extent to which it is present. And that's an important element. What we usually find is when you present an issue to the Bureau or they come across an issue, they'll first go to that aspect of the definition. And the thinking is if they can immediately knock out of the box that the loan originator can't affect this factor at all, then they can end the inquiry there. So that tends to be how they handle it. If we go to the next slide now, that'd be great. Now, a lot of important issues facing the industry, and been thinking a lot. The MBAs have been thinking a lot about this, and finally came to the conclusion that no one could really come up with a good workaround within the parameters of the rule to achieve certain results. And the conclusion was we need to ask the Bureau to amend the rule. Now, we understood that the rule sort of was on the list of the Bureau as something to address, but it wasn't particularly high on the list. So what the MBA did was engage in a concerted effort to bring the rule up higher on the list, and three issues in particular. And here are the three specific asks, and then I'll go into a more general ask. The first is to allow individual loan originators to voluntarily lower their compensation in response to competition. So the thought is you get it all the time, you're dealing with a consumer, they come in with a loan estimate from a competitor, has a lower rate, they want you to meet it or beat it. And right now we've talked to the Bureau and they said, no, the rule doesn't allow the LO to lower his compensation in that circumstance to meet or beat the loan price. So that's ask one. That's a difficult ask, I must say. Second is we've run into a lot errors where the commonplace before this rule when an originator made an error and it affected you in the pocketbook, you hit the originator in their pocketbook for that error. That's a second ask. Allow us to do this because they've said you can't do it if it relates to a loan term, and usually when it relates to a loan term, that's when the financial hit occurs to the company. And the third, we all know these housing finance agency loans, often referred to as bond program loans, very restrictive in terms of rates and fees, also very protective of the consumer in terms of all around what they can be charged plus the underwriting guidelines. Very difficult to offer that product and pay standard loan originator compensation. So it's really inhibiting the offering of this product to low and moderate income individuals and affecting access to credit. That's a bad thing. So this is an ask. Allow us with housing finance agency loans to pay differently. Of the three asks, this one does have sympathy at the Bureau. They just want to figure out a way to do it if they're willing to go down that path that doesn't result in originators steering consumers away from this type of product. That's the concern on the other side. Those are the three specific asks. A general ask. This rule is very hard to apply. The proxy concept is very amorphous. Can we get some bright lines? Can we get some guideposts that have clear do's and don'ts? advantage of that is when something's bright line, there's a clear do and don't. You know what you can do, you know what you can't do. The problem, that's rigid. That can be rigid. So we have to balance the rigidity that might come out of more guidance with right now where we have a very amorphous rule. With that, now turn presentation over to my colleague Michael. So we go to the next slide, and he'll address some specific scenarios that we often see.
Thanks, Rich. Hello, everybody. I'm going to take you through some scenarios that Rich and I often get questioned about. Many of these, there's not an exact answer, but we'll try and bring you through it. In preparing for this and speaking to Rich a couple of days ago, we were laughing because we've both gotten calls over the last quarter, say 3-4 months, where people are asking us, did the LO comp rules change? And it's sort of an odd question to get because they haven't been changed in 5 years or so. And the reason we're getting that question is because there's a lot of things going on in the marketplace and people stretching the rules, coming with creative ways around the rules. So as people hear things about other lenders, what they're doing, other LOs, other branches, they're saying, hey, the rules changed. We didn't think you can do that. So just thought that was kind of funny that we both were getting that question. And think about, as we go through these scenarios, think about risk. Rich and I don't have to turn your lights on. We don't have to recruit. We don't have to retain, right? So it's very easy for us to live in the world of no, right? But us living in the world of no sometimes puts lenders out of business, and that's not really where we want to be. So think about risk, right? There's a different risk level with certain things you do. Is the risk level I'm going to be on the front page of the paper? Is the risk level I'm going to be fined several $1 million? Or is the risk level that someone's going to tell me to stop doing it, right? Big difference there, right? A regulator telling you to stop doing it versus fining you several $1 million and putting you on the front page of the paper are completely different risks. So think about that as you're going through this, and I'll touch upon that a little bit, and Rich as well. First thing I want to talk about is a loan program. And this is has been going on, getting questions on this forever. And in a vacuum, the answer is no, right? The answer is you cannot vary compensation based on a loan program or a loan product. And the CFPB and some federal regulators have taken on their view that loan products, loan programs are just a bundle of terms and conditions. So you can't vary compensation on them because you can't vary compensation on terms and conditions. So that's pretty much in a vacuum. Now, there are lenders that are pushing the envelope, might be a little strong, but they're saying I have to vary it. There's certain programs, Rich just spoke about the bond programs. I'm not going to make a point or 3/4 of a point and pay out 150 basis points. It's not going to happen, right? I can't do that. So I have to pay these bond programs less, right? Same thing on jumbos. There was a time with jumbos where if you were over a point, that's all you were getting paid, right? So if your compensation was 150 basis points, you were losing 50 basis points on every jumbo loan. And lenders were saying, I'm just not doing it. I'm in the business to make money and margin compression, everything else. So you have to decide there. It's a lot of loan compensation agreements that I review. Rich mentioned the same thing when we were preparing. Have that in there. They have compensation that varies based on jumbo or bond programs. I'm not telling you can do it. I'm saying it's out there, and I think you have to look at what this rule was meant to do. The rule was meant to prevent steering. So you better have a damn good answer as to how nobody is steering someone away from a bond program or away from a jumbo loan to earn more compensation. And I think that that's reasonable that you can do that, but it still does not change the fact that within the four corners of the law, this is not permitted. If you get in a conversation with a regulator and you have a chance to explain why you're doing it, the procedures you put in place to make sure no steering occurs and the borrower is not affected, well, you're better off there than throwing up your arms and saying I did it and I know I did it and it's wrong and there could be steering, but I'm doing it anyway, right? So just have an answer to that. Moving on, I don't know if Rich, you have anything to add there, or I'll move on to brokered and bank loans.
No, that's fine. Yeah, please go ahead.
This is another question, again, often comes up. I don't think that there is a one-size-fits-all answer here. I think that, certainly some compliance experts say, no, you can't do it. Others say you can in certain circumstances. I think you have to look at one of the things you have to look at is the reason for the brokering, right? If you're brokering a program that you do not have, right? You don't offer this program, whether it's a low FICO score, whatever it is, right? You don't do reverse loans, whatever it is. The program, the product you don't do. think you have a pretty good argument that that's not a term or condition, and it's not a proxy, because the loan officer doesn't have the ability to do that program with you or broker it, right? So I think, yeah, I personally believe you have a pretty good argument there if you're brokering, only because you don't have the program that you can pay differently on brokered versus banked loans. Where it gets a little bit dicey is when you're brokering for price, right? If you're brokering for price, right, now you're bringing in a proxy factor because the loan officer has the ability to either broker for the price or not broker for the price, right? So that's where you have to be careful. The people say to me all the time, how could a regulator get upset with me when I broker for price? I'm giving the borrower a better deal. So if I'm paying the loan officer less, the borrower's getting a better deal, everybody's happy. When you look at it in a vacuum, yes, that's true. But if you look at it another way, you brokered this person, why didn't you broker the other 99 people? You banked them and you made more money. Did you bank those loans because you made more money, right? Why did you pick out this one borrower with a broker for price where you made less money? Now, my answer to that is because I'm a bank, I'm not a broker, right? I'm here to bank loans, I'm here to make loans and to sell loans, not to broker loans. But you see the issue there. If you're brokering for price, you're coming within that proxy definition that Rich went over, because the loan officer then has the ability, and again, it's not did they influence, it has the ability, right? So the loan officer has the ability to determine whether that loan is banked or brokered, and I think you're in that proxy scenario. The last point is, if you are going to do that, I would suggest you're paying the same for all loan lenders who you broker to. That's a one price, one size fits all for that, and you do limit it to those programs that you don't have as a lender. If we can go to the next slide. Next scenario deals with lien status, whether it's a first or second lien for the most part. I think it's likely a transaction term if you boil it down to it. Again, I think there's some competing views, and I think that you're in the stage here, if you're doing this and varying compensation based on lien position, lien status, where you better have be able to explain yourself and show that there's nothing that's borrower facing that can cause borrower harm, that can cause steering here. Again, I see it in a lot of compensation agreements. I see it in a lot of compensation agreements that you don't get paid on seconds. If they're piggybacks, 80-20, something like that, you're just not getting paid on them. Again, to me, I think you can go in that direction. I haven't seen too much pushback from regulators in that regard. I do think there's others that are in the compliance field, the colleagues of Rich and I, that would beg to differ. But I personally feel that you're in a spot on an ordinary first and second where the loan officer really can't make a decision there. Someone's generally getting a second or a first, and you don't really have a choice there of which way to go. So I think all the reasons for putting this loan into effect really don't come into play here. And to me, it would take a pretty aggressive stance by a regulator to come at you on that particular issue. Next scenario, which is pretty popular, is referral source. And again, looking at it in a vacuum, no issues whatsoever. It's not a term or condition. It's not a proxy. LO can't control where a loan comes from. The most popular, the most way that this is used is with a loan officer lead or a lender lead. All right, so lender provides the lead, they're paying less than if the loan officer sourced the lead. And the theory behind that is the lender's paying for that lead, either by advertising, by buying leads, whatever it may be. So there's no problem there, paying differently based upon the loan originator or the lender source. Where it gets a little bit, again, iffy is when you expand that out, right? You have this little narrow paying by source, lender or loan originator is fine, but now people expand that out and they try and extract that into other things. And now you have different lead generators. Can I pay by that? I use LendingTree, I use Zillow, I use 5 different lead generators. Can I pay 5 different compensation amounts based upon where that lead came from? You probably can, but again, you're getting it more difficult. Your record keeping is more difficult. Your ability to show where the lead came from is more difficult. Perhaps you get a lead from 2 different sources, the same lead, the way these leads are, regurgitated these days, and they're not exclusive. So where does that go? So as you open it up, I think it presents some issues. I don't think that it's telling you can't do it, but just recognize those issues that might present themselves and realize how you're going to deal with them. Another question relating to sourcing of loans deals with MSAs. If you have a marketing services agreement, can I pay loan officers different on leads coming from that particular MSA? And I think you're getting into dangerous territory, really, where these MSAs are, right? And you're just really trying to cut into the LO for the cost of the MSA. Again, could FHA make a question or raise a question because it's origination expense? The MSA is an origination expense. So you're just trying to recoup that. So I think there's some factors there. I personally don't like that, although I'm not sure in the rule I can point to a place where it says you can't do that. I think that whole scenario doesn't look good, especially in an environment where most regulators are skeptical about MSAs, despite CFPB backing off of them and some of the court decisions. I think they are skeptical about them. And, when you think about it, without RESPA, there wouldn't be any MSAs. There wouldn't be any MSAs out there. So you have to look at it as it's a way of avoiding RESPA, even though you're setting it up in a way that you're really paying for marketing services. So I just think when anything off the straight and narrow dealing with MSAs, you're asking for regulator scrutiny. But again, I'm not sure I can look in the rule and tell you that, hey, you can't pay a loan officer differently when the source is from a particular MSA or particular realtor as opposed to somewhere else. But again, I think you get into dangerous territory. And the last thing is that, just because you have different lead sources and you're paying different amounts for different lead sources, whether it's just lender paid versus, lender sourced versus originator sourced or extrapolating upon that, it does not give you a license to manipulate the source for pricing exceptions. It doesn't. So, it's the oldest trick in the book. Everyone knows about it, and examiners know about it. There's a few state examiners I can think off the top of my head that they will look at that. They want that field locked down. When that selection is made for the source, whether it's a loan originator source, the lender source, they want that field locked down. No changes to be made to it. Now, again, can you have a change? Can someone make a mistake? But they want someone pretty high up to be making that change and memorialize why that change is made. They don't want you manipulating the source to let the LO pays for pricing exceptions. Again, you're just backdooring what you can't do through the front door, whether it's fair or not, whether the consumer is benefiting or not. I would stay away from that. Again, it's not a consumer-facing thing. It's the LO and the lender, but it's something that I've seen regulators really not like. And it's not that hard to see, right? It's not that hard to see when every pricing exception is lender source. You can see the trends. So, don't be cute there. Be very careful. It's a great idea. It came up years ago, but it's something that, everybody and their brother is onto and knows about. So just be careful, manipulating that source for pricing exceptions. Should we change the screen? And Rich, you want to take this one?
Sure. Thank you, Michael. Again, number of questions we often receive. Can we pay different based on purchase loans for a purchase purpose, or it's a refinance loan? And the first thing you go to is, well, is it a loan term? And this isn't product, this is purpose. And from what we understand, the Bureau's view on that is purpose really is not a loan term. They didn't consider that in when they were contemplating what is a loan term or is not. This is something that falls, at least that purchase refi falls outside of that. But is it then a proxy? Because even if it's not a loan term, is it a proxy for a loan term? And here it's important to remember the concept of proxy. And the second element was the ability of the originator to affect, this factor or the extent to which it's in at a particular transaction. Well, if a consumer is a first-time home buyer, so they're going for obviously a purchase money loan, obviously that's it. There is nothing to refi because there is no existing mortgage loan. So obviously the originator has no ability to affect whether that consumer is getting a purchase or a refi. Now take a homeowner who has an existing home and a mortgage, and they're thinking perhaps of refining, or they're thinking perhaps of buying another home. Could originator in theory convince them to do the other thing, particularly most likely if they're thinking of doing a refinance and they said, no, this is a great purchase market. You need to purchase, you shouldn't really refi. Well, theoretically, among the things that could happen in this world, that's probably a possibility in some cases, but we all admit that's probably pretty remote in most cases that would ever really occur. And in informal discussions with bureau staff, that's sort of the view. They say they'd look to see if there was a unique situation where the originator actually was able to push a consumer one way or the other, but their general assumption would be, no, if the consumer comes in for one or the other, that's it, and the originator really can't affect it. So based on that, they're thinking it's not a term, it's not a proxy, so that does seem to fit into the permissible area to vary compensation. Now, state where the property is located, this is actually more directly addressed in the rule itself. What they did is when they added the proxy concept more defined in the revised rule, they gave us a couple of examples. And one of them is actually property located in state A and property located in state B. Now, the state location is not a loan term. It's where it is. The type of collateral actually is a term. That's so whether you were talking about a condo or a single family home or a manufactured home that was subject to the rule, that is a loan term. But location of it is not. So now the question is, well, is it a proxy? And the example they have in the rule is two different states. A lender makes loans in both states. The originators can make loan in either state, assuming they're appropriately licensed to do so. And in one state, the rates are higher and the compensation is higher. In another state, the rates are lower and the compensation is lower. Now, do we have a proxy? And the position is the originator pretty much can't affect the state where that property is located in. It's either in state A or it's in state B. Again, they note, could there be an originator who might be able to convince someone to, well, you should buy in state A, not state B, or vice versa? Maybe, in the theory of things that are possible in this universe, but that's probably pretty remote. So again, the thought is, no, originator generally can't affect whether it's state A or state B, so it's not a proxy. Well, I always note to people, though, I go, remember, this is not the only law in this fair country of ours. Location and varying prices and compensation by location could have fair lending implications. So if you do that, I go, good to analyze it. Most people, when they're varying prices from state to state, and states often viewed as a large enough geographic area not to raise the fair lending concerns that if you try to go down to the city level. But the thought is, if you could demonstrate that you're meeting the market simply, and that's all you're doing, that would be a helpful factor to have those records. Last point on this slide: credit score. And we actually have a history here based on the original rule and the revised rule. Credit score itself, obviously we know it's an underwriting component, but it's not really a loan term. So the question is it a proxy for a loan term? Well, interestingly, the original rule had an illustration in it of the proxy concept, and this is what led us down a path of confusion, because it became very difficult to apply the illustration in various cases. But basically, there were two different consumers. One had a credit score of 650, one had a credit score of 800. The one who had the 650 credit score got a loan with an interest rate of 7%. The one with an 800 credit score got a loan with an interest rate of 6.5%. The compensation to the originator for the 7% loan was $1,500. The compensation to the originator for the 6.5% rate loan was $1,000. Original rule said the credit score there is a proxy for a loan term. The interest rate, compensation varied based on that, would be a violation of the rule. That illustration no longer exists in the revised rule. And in finalizing the revised rule, where they added the definition of a proxy, they noted they had proposed to delete the credit score example, and what they indicated is under the proposed definition, credit score may or may not be a proxy for a term of the transaction, depending on the facts and circumstances. So they removed it as a clear illustration and indicated may or may not be. When that came out, we sort of asked them, well, could you enlighten us as to may and may not be a proxy? And what we were generally getting there is they don't always want to foreclose that nothing could ever be a proxy unless you're in very limited circumstances. So they leave the door open, it might be. But in general, it appears their view is a consumer's credit score is a consumer's credit score. And, can you affect that credit score the way it exists right now as an originator? And the thought is in most cases, probably not. Put aside credit repair and those types of things, which over a period of time try to change that score. But their general view appears to be, look, in most cases, it's like their income. Their income is their income. Their credit score is their credit score. So it's something the originator probably can't affect, which is why they removed the illustration, because it was inconsistent with the way they had defined proxy. And the way they define it now, it's probably not a proxy in most cases because the credit score is the credit score and the originator really cannot affect that. With that, turn it back over to Michael for a few other scenarios.
Thanks, Rich. Okay, with three more scenarios. I'm going to go through these rather quickly so that we have some time for questions at the end here. The first is an error by a loan originator. Again, this is not a fairness rule. It's not fair, but you generally cannot ding the compensation based upon an error by the originator. They do some bonehead thing. They lock a loan incorrectly, or they lock a loan for 15 days when there's a 60-day, closing date on a purchase, or what have you. You're going to eat it as the lender. Again, and there are some other laws that are here. You are in the wonderful state of California for the most part, where I don't think they believe in employer rights, or maybe say they only believe in employee rights. So, dinging the compensation for an error will probably run afoul of many state labor and employment laws, and certainly, California. What they want you to do is, and there's also FHA implications. Again, is that an origination cost, right? An FHA, the lender has to pay all the origination costs. Probably is, right? I think that term is you can take it as far as or shorten it as much as you want, but I think that would be an origination cost. What they want you to do is they want you to prospectively adjust their compensation. This LO screws up all the time, or whatever he's doing to affect your bottom line as a lender, as a business owner, then compensation going forward should be reduced, right? And you can say that the other way, right? If someone's increasing your bottom line, it can't be dollar for dollar where you're keeping a black book as to how much income you have because they did FHA loans versus conventional, but they want you to prospectively go ahead and adjust compensation, not retrospectively, not with respect to any loans that they already have originated and are part of the compensation plan now. So is it fair? No, but life's not always fair, and certainly LO comp is not fair. Early payoff, early default, EPOs, EPDs. Again, you have some state labor and employment laws here that you have to be careful of. Again, a lot of them don't allow it. All right, they don't allow it. There's very few things you can ding compensation for. The FHA implications as well is that an origination cost. You have a lot of LO comp agreements being written these days where the compensation is not earned until 6 months down the road after the loan closes, and it's not earned unless there is no EPD or EPO during that 6-month period. I think the jury's still out how those will stand up before some state labor boards. I think from an LO comp point of view, I think you're okay. Whether or not from a state labor and employment point of view, they'll allow you to, again, make that compensation earn 6 months after the closing date, although it's paid as an advance on the closing date or on the funding date or close to that 6-month period. Will they let you backdoor what you can't do through the front door? Will they let you do it that way? And again, I know a lot of agreements being written that way. I think it's very creative. It's good. Go with it. But I'm not sure that there won't be some state labor and employment boards out there that would have a problem with that. That you're just backdooring where you could essentially ding an LO for an EPO or an EPD when you couldn't they really don't want you to do that. So I think the jury's still out on that. The last thing is the loan assistant. We get questions a lot, and it's a troubling thing for lenders, right? If LO using an assistant and they're paying the assistant, right, I want to take it out of the LO's compensation, right? So the LO's getting 150 bips and the assistant's getting 25 bips. I'm going to just pay the LO 125 bips. that's fine. Make the change to the LO comp agreement. The LO's making 125 and the assistant's making 25, right? That's nothing wrong with that. But what you can't do is keep the LO at 150 basis points and saying he's going to pay 25 basis points on any loan he uses an LO assistant, because it doesn't work under LO comp laws. It definitely doesn't work under FHA rules in terms of paying origination costs. You cannot with a straight face argue that an LOA compensation is not an origination cost. So, where you have that problem is when an LO uses an assistant some of the times, right? Because then you can't reduce the LO's comp by the assistant's comp on a wholesale basis, rewrite their agreements, reduce one by 25, give the other one 25, because it's not used on every deal. So that's where the problem is. But there's not an easy answer there. I would definitely try and sway you away from having the LO pay the assistants directly. And with that, I don't know, Rich, if you have anything else to add, feel free. Otherwise, I'll turn it back over to Monica and we'll see if we have any questions.
Great. Thank you guys very much. And at this point, we're going to open it up to questions, and I'm going to let Susan sort of navigate through those, if you would.
Sure. We do have a few questions, and thank you, Rich and Michael, for that presentation. First question is, if 100% of loans are serviced by a mortgage company, can you pay extra compensation for as long as the client's loan is being serviced by the mortgage company?
It sounds like they were almost asking, obviously you're not going to know that at the time of origination. It would almost be, and I've heard of this, some companies are trying to come up with a concept of, to the extent they service, that the longer, originator A's portfolio stays on the books and continues to be serviced, that they'll periodically, pay them a fixed percentage for, the portfolio. It sounds like that's the type of arrangement they're thinking of, almost like an annuity type of thing. And what I raise there in general, though, you have to look at all the factors. If it's paying an additional amount, not for the origination, but for the loan staying around a year, 2 years, 3 years, in general, that's probably going to be okay. You want to make sure it doesn't affect behavior at the time of origination. And you also want to check with, because when you get into this, you want to talk to a benefits lawyer, because you could trigger various type of benefit rules and such in terms of having these, I call them annuity type arrangements. Michael, do you have any other thoughts with that?
I'm in line with what you're thinking. I don't think it is LO comp. If it doesn't go back to the origination or what was done, or the choices that were made at the origination. So I don't, in terms of, so I don't think it's LO comp. But you're right. There are some other rules that I think you have to, pay attention to.
Okay, thank you, gentlemen. Next question. Would an LO that's a licensed real estate agent violate LO comp if on the same transaction the LO is acting as the originator and the real estate agent? I understand it's not an absolute no on I understand it's an absolute no on FHA loans, but what about conventional VA and USDA?
Well, I don't think it violates LO comp per se. I personally think it's an area where you're going to get in trouble if you're doing it. And I'll give you just a couple of examples. What happens if you're the realtor and you're the LO on a loan and the borrower loses their job the day before the closing, or there's a flood in the house the day before the closing? You have a fiduciary duty to your employer, who is the mortgage company, and you also have, as the LO, you have a fiduciary duty to the borrower, to the consumer, as the realtor. Which fiduciary duty are you going to break? Are you going to tell the LO and screw the borrower? Or are you going to tell the lender and screw the borrower, or don't tell the lender and screw the lender, right? Now, that's not going to happen on every single deal, right? But those things do come up. Borrowers do lose their jobs, the day before, 2 days before closing. And I think the realtor at that point is in a position where they have to make a determination, and neither one is good for one of the people who they owe fiduciary duty to. So again, I don't think there's an outright prohibition on the conventional side, and I don't think it violates LO comp, but I still think you got to be careful in that scenario.
Okay, thank you. Next question. This is actually asked a couple of times. Are non-QM loans subject to Dodd-Frank?
I guess they're asking, are non-QM loans subject to the LO comp rule?
That would be my assumption.
That would be my guess. Yes, they are, and so we get the question: can I pay differently for QM or non-QM? And because the way that's defined, you often have to look at the specifics. If it relates to a loan term, or particularly the pricing of the loan, because remember, if let's say it's non-QM because it doesn't meet the points and fees test, then you'd be varying compensation based on a loan term, points and fees. If it's an underwriting factor, that, in other words, you set two loans side by side, they're identical in terms of terms, conditions, everything. Only one was underwritten with one formula, one was underwritten with a different formula, and those formulas don't relate to loan terms or proxy for loan terms, then there probably is an ability to vary. But you can't do it on QM, non-QM. You have to do it on the specific basis for variance in each loan. So that's why it's difficult. You can't do an across-the-board answer, yes or no.
Okay, understood. We have a few more questions, so if you're okay to go a few minutes over, we'll try to whip through these. Next question: with respect to wholesale origination, can a broker choose to be paid as either A, lender paid, or B, borrower paid on a loan-by-loan basis?
Yeah, I think that's fine. Where you get into some of the complications is when you're changing on the same loan, right? You're going from lender paid to borrower paid, or borrower paid to lender paid when it's already been selected. And while I don't think there's any outright prohibitions in the rule, I think you have to look at why that's being done and make sure that it's the consumers that are involved and that it's a benefit to the consumer. The consumer is the one that's supposed to make the selection of lender paid or borrower paid, right? So telling the borrower they have to flip from lender paid to borrower paid because the deal doesn't work right for the lender is a dicey place to be. And now, again, you can phrase that a lot better, but I think the reasons why you are going from lender paid to borrower paid or borrower paid to lender paid, if you are a wholesale lender, you need to know what those are. I don't think it's just free willy to go and change, because if you have the borrower, the benefit going to the lender or the LO, to the detriment of the consumer, that's never a place you want to be in. So I do think you have to look a little bit deeper when that happens. And as a best practice, I think most people would agree that when you're switching from lender paid to borrower paid, that borrower paid never exceed the amount the LO would have made or the broker would have made on the lender paid transaction.
Similar question, a little bit different though. Is there any indication that the CFPB will provide more clarity around lender paid compensation versus borrower paid? We've seen this participant saying they've seen lenders allowing brokers to change from LPC to BPC and lower price during the application process.
We've discussed, and it's in the context of MBA discussions that I happen to be involved with the Bureau. Not a whole lot of guidance. They did confirm, as Michael said, you couldn't do lender paid. When they come in, it could be lender paid, it could be consumer paid. They're okay with that. We also said when they show up on my doorstep with consumer paid, do I have to police how they got to that number? And the Bureau was no, but once they're on your doorstep, then you're in the soup at that point. So if they want to switch, as Michael said, you got to analyze that very carefully, because then you would be involved once they show up at your doorstep. I will tell you the one thing where I think that will be a concern based on the trend I have seen, and if I have seen it, then I have to expect the Bureau will see it if they've not seen it already. When you analyze transactions from a fair lending basis on whether it's consumer paid or lender paid, what you will often find is white non-Hispanics predominantly will get the consumer paid, and it will be lower comp at a lower price, and protected class members will get lender paid, higher comp, higher price. That will cause the Bureau to act at some point. So I'd be very wary if you see that happening in your shop. That is what's going to cause the Bureau to step in on this issue.
Yeah, that's a great point. Great point.
Some of these are repeat questions, so I'm trying to go through these. If we have an accommodating LO doing a loan in a state where the referring MLO is not licensed, does the accommodating MLO have to make the full comp for their comp plan from the transaction?
They do have to make what their comp plan states. I mean, you can look at whether or not they do have a distinction between lender sourced and loan officer sourced, or loan officer sourced and lender and everything else sourced. Because if it's coming from an LO in the company who's not licensed in that state, you might be able to treat it as a non-LO sourced, in which case you probably have a lower comp plan for that LO, for the LO on a deal, and might allow you to have some, extra comp to pay a referral fee or some type of a fee to the LO that initially took in the loan that was unlicensed. With that, just be careful. I don't want to go off a tangent, but paying referral fees to LOs, you have an outright exemption under RESPA if they're an employee to pay a referral fee to an employee. But there are several states out there where they don't agree. They want, if you're paying based upon a loan, they want that person licensed. So you have an LO California, an LO in Florida. The California LO gets a Florida deal, gives it to the Florida licensed LO. That loan closes it. The employer wants to pay a referral fee to that California licensed LO that gave the loan in Florida. Florida doesn't allow it. So it's one of the states that don't allow it. So just be careful. Even though the federal law RESPA allows it, there's a handful of states, couple of handfuls of states that don't allow you paying a referral fee to an unlicensed employee.
Got it. Okay. Well, that concludes today's webinar. Thank you both for a great presentation, really valuable information. This webinar is being recorded and will be available on our website probably in the next few days. So you'll feel free to come back and catch some of the scenes or that you would like to revisit. Next month, we will have our compliance webinar on July 25th, the topic of anti-money laundering, and our speaker will be Robin Holyoke from the Compliance Group. Thank you all for joining us and have a great rest of your day.